Today, I want to talk to everybody about this concept of the great rotation. My name is Derrick and I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. This is my current position disclosure. These are the positions I have right now. I may or may not bring up some of these stocks over the course of the video today. So, there's been a lot of chatter about this, so I want to nail down what is the great rotation, what does it stem from, and what does it potentially mean for you as a trader or as an investor. Basically what the great rotation is, or what it means, this chatter that maybe you've heard about, is talking about money coming out of, rotating out of growth type stocks, high multiple type stocks, and then rotating into your value type stocks, your more lower PE multiple stocks, maybe businesses that are more established, are more cash flow based. Where does this come from? Let's take a step back. We need to talk about interest rates. And to talk about interest rates, we're going to have to talk about inflation. But let's start a little bit with interest rates, because this is the key concept that is really creating the potential of the great rotation. Interest rates are supposed to be going higher. That is what the Fed has told us. We're looking at 3, maybe even 4 interest rate increases here in 2022 based on what the market is pricing in and based on what the Fed has been telling us. So interest rates have been historically low for the last 10 plus years now. Ever since the financial crisis in 2008, 2009, we brought interest rates down. They have basically stayed at or near zero, and then when the Fed runs out of bullets to stimulate the economy because interest rates are already near zero, that's when they begin to engage in things like quantitative easing, which also weighs on interest rates and keeps them lower. So what do really low interest rates mean for the marketplace? Well, if you have really low interest rates, if you have the Fed funds rate at basically zero like it's been, it means that the cost of capital, the cost of money to institutions and companies, well, there basically isn't one. Money's basically free. So when interest rates are at zero, it's very easy for growth companies, a company that has an idea, but it might take years of building out that idea and potentially losing millions, billions of dollars before that idea can come online. It really means that those companies can exist. If a company like Uber or even a company like Tesla might not even be here today if it wasn't for the fact that we have had these historically low interest rates for so long. Those companies have been able to lose billions of dollars since they've been founded, with the idea that eventually they'll reach enough scale that they can then switch on the profit-taking button and then all of a sudden start making real money because of the scale that they have created at that point. It's basically the Amazon model, right? Everyone loves to call themselves the Amazon of ride sharing, or the Amazon of electric cars, or the Amazon of whatever. That's what Amazon did, right? Amazon lost money for a long period of time, really built out their scale, and now they are the company that we know of as today. So that's what interest rates have done to the market. They also allow companies to trade at really high PE multiples, price to earnings. And that is because when you're looking at markets, they all compete with one another. This is a really important concept to understanding markets as a whole. What does this mean, markets compete with one another? Let's say I have 100 investable dollars, and I'm trying to figure out where I want to invest that $100. Well, I have to think about where I can get the most potential return, but I also have to think about what the risk is to me with that investment. So I could choose to invest in federal bonds, I could buy a 10-year treasury, but the return on that is going to be so low that it can't even keep up with inflation, but it's extremely safe. Or I could invest in the stock market. Stock market has historical returns of something like 7 to 9% if you go back 100 years, but it does it with a lot of volatility. So that volatility is risk. I could take that $100 and I could put it in treasuries and get a little baby return, but with like no risk. And maybe if that 10-year treasury note was at 1%, then it's not worth it for me to put my money in that. I'd rather take my chances with the stock market. But maybe if that 10-year treasury was 4%, then I'll say, you know what? I'll take my 4% risk-free, and instead of maybe getting a little bit of a better return from the stock market with a lot of risk. So that's what I mean by asset classes compete with one another. And it's not just the stock market and the bond market. You got the crypto market, you got the gold market, you got now the NFT market, the art market, real estate. All of these different marketplaces are competing for your investable dollars. And where your investable dollars are going to go is going to depend on risk reward, just like everything else. So this also plays out within the stock market itself, right? When you're in a market environment that has very low interest rates, it enables stocks to trade at higher multiples because the potential return for the risk is just more attractive. So a PE multiple, price to earnings, that is the price that you are willing to pay for every dollar of earnings that comes in. And we have been trading at, really high multiples for quite some time. And again, it's enabled these growth stocks to do all this crazy stuff. But now all of a sudden, we're in an environment that is potentially changing. Interest rates are potentially going up. And now to bring up some charts here, we've seen already huge rotation from growth names into value type stocks. So when we're talking about value type stocks, there's a couple key sectors that really stand out in my mind that I think of right away. I think of financials, I think of energy stocks, I think of certain consumer staple stocks. So we can take a look at what some energy stocks have done. Look at what this XLE, the energy ETF, has done recently. It's been on fire for January 2022 so far. And it's actually been performing really well since November 2020. We can look at the XLF. Again, same thing, on fire since 2022 has began, and has also been performing really well since November 2020. That's when these things really started to wake up. We can look at certain consumer staples. Look at the run Procter & Gamble has had since December. Procter & Gamble make toilet paper, they make shaving cream. This is not the first company that you think of when you think about getting extraordinary return from the market, right? You're probably thinking about Tesla. But look what Procter & Gamble just did. Procter & Gamble was able to go from $145 to $165. It's a big move in a 1 month period of time. So that's been a rotation into value from growth. Look at what some of these growth stocks have done. It's been a nightmare. Square pulling back from $290 to $133. PayPal pulling back from $310 to $180. Look at some of these AI companies, right? AI. AI has gone from, oh my gosh, this thing was trading at $176 and now it's at $28. Look at Palantir. Palantir in February 2021, this was a $44 stock. Now yesterday, from when I'm doing this video, it was below $16. So you've already seen a huge move out of growth. But you have to have some perspective. Where were these companies just in 2019, or where were they just before coronavirus started? Palantir is a more recent IPO, but Palantir IPO'd at like $9 or so, $10, and then was able to have this big run. So even here at $16, $17, it's still trading at a decent premium from $10. What about like a Jumai, right? This one's been around for a while here. Pre-coronavirus, it was trading at around $7 or so. Then had this insane run. Obviously, money became really easy. Fed was doing historic amounts of stimulus that enabled these growth stocks to go crazy in the beginning of 2021. Stock went from like $7 to $70 and now has, pulled back to $11. So we have plenty of examples, just plenty of examples of growth stocks that have had huge runs followed by huge pullbacks. And again, a lot of the recent selling, it's been particularly brutal for a lot of these companies the last couple of months as the Fed has begun to forecast the increase in interest rates. Because that is when people want to go back to value. That's when these companies, let's say you're an Uber, right? And a company like Uber that has just been a money-losing company for so long, but has been able to be reliant on the fact that money was free, so you could keep raising new money from investors all over the place. They didn't have anywhere else to put their money except for in your hope and in your dream. This company wouldn't even be able to get off the ground if you had really high interest rates. So the argument that the value people have is that as interest rates come back online, then the companies that actually give you something for your money, that actually produce earnings, like a traditional oil company, that's going to have real value in a higher interest rate environment. They don't need to raise money left and right because they are money producing machines, as opposed to a company like Uber, which now Uber's become a little bit more mature. You know, maybe they are pretty close to being profitable, but the next generation of Ubers, a lot of these other spec stocks that have been out there, the Cathie Wood stocks, the ARK stocks, those things, well, maybe they're worth nothing. Maybe they're actually zeros in an interest rate environment that's at 4 or 5%. So it's an interesting argument, and it's basically the argument between growth and value. It's basically the argument between Warren Buffett on the one hand and Cathie Wood on the other, right? But to take a step back, you have to understand inflation, because the driving force right now that could really create substantially higher interest rates is inflation. And this is where you get into your argument of the heavy Warren Buffett types right now, the heavy value players, versus the people who think it's a dip buying opportunity in ARK and Cathie Wood and in the speculative stocks. So how and why does inflation affect interest rates? Inflation can be a really scary thing, right? All of a sudden, the dollars I have in my wallet right now, tomorrow, they're worth less than they were today. Well, that's not good, right? That's scary. I worked hard for those dollars. I don't want them to just all of a sudden become worthless. But we've been in a very low inflation environment along with our very low interest rate environment for a long period of time. And that's interesting because if you go back to the financial crisis, if you go back to 2008, here we are, 2008 into the beginning of 2009 when we bottomed. This is the first time that the Fed unleashed all of its powers, brought interest rates to zero, implemented quantitative easing for the first time, and it was really controversial. I remember for myself the first time that $1 trillion number got thrown around, like, oh my gosh, we need to bail these banks out and stimulate the economy to the tune of over $1 trillion. It just sounded so crazy. I remember having conversations about it, and everyone was like, well, you put trillions of dollars into the economy, it's going to cause inflation. And the biggest surprise for economists coming out of the financial crisis is actually that it didn't lead to that type of inflation that everyone expected. Why? Well, there's a couple of reasons, but a couple of the biggest reasons are globalization and innovation. Think about Amazon. For better or worse, Amazon has put a lot of mom and pop businesses out of business. And that's not a good thing, right? You know, we want our mom and pop businesses to survive, but it's done it at the benefit of the consumer. Now, instead of having to buy this product for $10 at that mom and pop store, I could buy that product for $7 from Amazon because they have that competitive advantage with their size and with their scale. Well, if the cost of goods come down because of innovation like that, that lowers inflation. Also, globalization. Globalization has been a huge trend for the global economy up until very recently. The politics from both Democrats and Republicans have gotten much more anti-globalization recently and about bringing things back home because we saw some of the potential dangers of globalization that came from coronavirus when all of a sudden people didn't want to export those goods anymore that they were producing. But the concept of globalization is an international economics concept that basically states that countries should do what they're best at. So if what you're best at is providing a certain service, that's where your economy should focus on, because you can do it best and cheapest. If your competitive advantage is in labor, that's what you should focus on, because you'll be able to produce things cheaper, and then all of the economies can trade. So these are some of the things that kept inflation down despite the huge amounts of stimulus that came in during the financial crisis. Well, guess what? The amount of stimulus that we put in during the coronavirus crisis almost makes the financial crisis stimulus looks like a drop in the bucket. And now, for the first time in my entire career as a professional trader, we saw maybe a little bit of inflation come in 2013, but for the first time ever, we're seeing inflation and it's becoming scary. Because when inflation gets out of hand, one of the best ways to damper down that inflation is to increase interest rates. We can take a look at, again, we can look at history. One of the most difficult economic eras of the last 100 years or so was in the 1970s, when inflation last got crazy. There were two major years in particular of double-digit inflation. I think 1974 had 12.5% inflation, and 1980 had 14% inflation. And then it took Fed Chairman Volcker in 1981 to raise the Fed funds rate to 20% to create an economic recession in order to damper down that inflation. He had to increase the Fed funds rate to 20%. Could anyone see Uber being a company and being able to get to where they've gotten to today, or Tesla for that matter, if it had to do it in an environment where interest rates were, forget about 3% or 4%, but 15% or 20%? It'd be pretty much impossible, because again, this all goes back to the competition for your investable dollar. That company that has a hope and a dream isn't going to get your investable $100 if you can get 20% for free from some sort of government-backed treasury note or bond. It's not going to happen. So the big debate right now on growth versus value stems back to interest rates, but that stems back to inflation. One of the big reasons why we're having inflation right now is supply chain problems, and that is a result of the coronavirus crisis. I think that we're going to be able to get through that. So does the Fed. It's just a matter of time. Another thing that is potentially increasing inflation is that we're pulling back from globalization. Think about how much your iPhone will cost if it was entirely produced in the United States. $1,000 iPhone? $7,000? Something like that? I don't think it's ever going to reach that point, though. Why? Because everyone wants to make money. And as much as we realized some of the dangers of globalization, and maybe we need to pull back from it to a degree, no one wants to buy an iPhone for $7,000. And Apple doesn't want to sell it to you for $7,000. They want to increase their margins, keep their margins as high as possible. So I think that that's going to have a limit as well. Now, and innovation, I'm a believer in innovation because I'm a believer in humanity. That same innovation that helped keep inflation down, that's going to continue with us. But there's other factors out there as well that might stick with us. We've seen an uptick in energy prices, oil. Your price at the pump's going up. Well, we have been producing less oil for a host of reasons. The problem that we saw back in the 1970s was that once inflation became the new normal, companies began to build their business plans out on inflation. So you got your business plan built on inflation. Whatever you're expecting that new higher price of your input costs to be next year, you're putting that into your business model. So you're already business modeling your higher input costs and your higher costs that you're going to be passing on to consumer. So it creates a virtuous cycle where inflation is here to stay. Our Fed officials know that, though, because they know history. And I think that they're going to do whatever they can on their end to try to keep that down. So this all comes back to, again, the battle between growth and value. You got growth spearheaded by Cathie Wood, ARK. She has gone from hero to zero so fast. Let's look at this ARK ETF here, right? She was just, everybody's here. The memes on the internet were getting insane. in the end of 2020 and into 2021. And now, oh man, the memes are insane in exactly the other way. The haters are out there. That's so big. I like to pay attention to this stuff because it's representative of sentiment. Market sentiment's a really important thing for a trader. Generally, you want to move with the trend, but when the thought processes get extreme, that's sometimes when you want to take the other side of things. So you've got Kathy heading up that growth camp. If you listen to her when she does her interviews, she's not worried about inflation. She's worried about the opposite. She's worried about disinflation. She's worried about all of a sudden your dollar is worth more. It's actually also a really bad economic event when that happens, but we'll save that for another video. And then you've got value, headed up by Warren Buffett, who went from being a hero to, well, let's face it, he's always been a hero for pretty much anybody who's ever been in markets. And look at the performance of Berk B recently. This is the chart I just pulled up, right? Berkshire Hathaway performing really well. Look at December into January 2022 here. Dramatic performance. Again, we can compare that to ARK. ARK clearly outperforming in 2020. The return on ARK in 2020 is insane. A low of 33 and change to a high of $160. Berk B, though, not too bad in 2020, but not the same type of result here. Looks relatively flat as we came from, pre-COVID and early 2020 to kind of ending the year. Big drawdown, just like everything else, and kind of getting back to flat, as opposed to ARK just giving huge returns in 2020. But, when oil started to pick up in 2021, when value started to pick up, everything was kind of performing here for a period of time. That did well. And now, again, recently, it has totally exploded. So, what's going to win here? Value and growth. Is the great rotation going to continue? Is it possible that interest rates are going to go up significantly more, and that some of these growth companies that we've been looking at, some of these ARK names, maybe are worth a donut? Maybe they're not worth anything because they can't even raise the money to continue their operations. And companies, those value companies that have been cheap from a fundamental perspective for a long time, are able to just continue. Is that going to be the winner? Or are we just going to go back to the same normal that we've had for the last 10 plus years? There's been a nice rally here in these value stocks, and they're going to take a break, and then growth is going to come roaring back. There was an interview recently where Kathy said she thinks that the return on investment on her fund could be 40% a year for the next 4 or 5 years. Is that going to be right? Personally, I'm in the camp of a little bit of both at the same time. Honestly, for me, for most of my career, that middle of the road thought process has actually worked out really well for me. I'm a believer in these energy names. I'm a believer in these value stocks. I'm a believer in these financials. Financial companies, the banks, they do better in higher interest rate environments. That's how they make their money. I'm a believer that you should have exposure to value companies that actually earn money in a higher interest rate environment. But I also wonder where we can actually get to with interest rates. We're coming from a Fed funds rate that's at 0. You give me 6 interest rate increases over the course of the next 2 years. At 0.25% in interest rate, you get me up to 1.5%. That is still historically low if you go back over 100 years. Interest rate of 1.5% is still extremely accommodative. So could it be that these growth stocks that are down now 75, 80%, some of them from their highs, have actually hit the point where it's a dip buying opportunity and some money can get rotated into them because they priced in and perhaps overpriced in the speed and the distance in which interest rates are going to go up. And at the same time, those value stocks can continue their relative strength, continue their trend, and continue to give you a return as well. That's kind of the camp that I'm in. But this is why technical analysis is so important. Everything that we just spoke about today is really important to understand. It's really important to have in the back of your mind as an investor or a trader. But technicals confirm your thesis. The fundamentals can tell you what you want to be involved in. What is your thought process? What do you think is going to happen with inflation and interest rates? Will tell you how to position yourself from a theoretical perspective. But this is why we go to technicals for confirmation. The technicals tell you the timing, they tell you the risk reward, they tell you how to manage the position if it's working out for you. Because even if you have an idea that's right, but you're early on your idea by a year or two, it's the same as being wrong. So I'm in the camp of a little bit of both right now. I think a lot of this is priced in, but I understand if I was looking at 5% interest rates, we could be going a lot lower with those growth companies. And I also am a believer that some of these value companies, particularly these energy names, as we're due for potentially higher energy prices, can continue to go up as well. And what does that do to the market as a whole? Up, up, up. So I'm still broadly bullish on the market as well, but again, the technicals need to confirm all of that, and they can confirm the timing. If you enjoyed what you learned on this lesson, we went pretty deep, give me some feedback. Let me know that you liked it. Give me a subscribe on my YouTube channel. Check out my team. I'm running the Pro Desk virtual trading floor. We have a really great team of professional traders that are in there. And you can also become a professional trader yourself with T3 Trading Group if you check out my ebook in the description below, or you hit me up personally to get more information. I'll see everybody out there in the markets.